are you? Can you guys hear me okay?
Very good.
All right,
And
cool.
happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through all the latest and greatest as it relates to the wild and wacky mortgage industry. And as always, pleased to be joined by my esteemed colleague, the only person to turn a free email newsletter into a global empire, Rob Chrisman.
Hey, Rich. Too nice.
And this week, pleased to be joined in the co-host seat by a good friend of the network, the founder and editor of thebasispoint.com, doing some work with our good friends at Total Expert, grizzled industry vet, Julian Hebron. Julian, good to see you, man.
Good to see you too. And you too, Rob. I'm looking forward to today for sure.
All right, excellent. Well, let's get into it. Rob, you've been breaking all these acquisition stories. Just anything on the Rocket Mortgage acquiring Julian's former employer, Loan Depot? Any rumors you got for us there?
They're in the market, right?
They said they want to make an acquisition. They put it out there, Rocket.
And so why would they want to buy Loan Depot again? What's the upside there?
Board, a lot of money, a lot of cash. Dan Gilbert, he owns casinos, Cleveland Cavaliers, biggest mortgage
Tennessee websites. Yeah. I don't see that one happening, but who knows? Stranger things have happened, right? There's a lot of talk out there. There's a lot of talk about companies with multiple channels with regard to wholesale, retail, correspondent, direct to consumer, whatever it might be, and looking at those channels very carefully in this kind of environment and trying to figure out what's profitable and what's not. And if they're not profitable, perhaps finding a buyer who is good at that particular channel, who can use those tools to beef up their own production and help the seller, limit their losses or in turn maximize the return for the acquirer. So there's a lot of that talk out there. I don't think we're bringing back the implodometer yet. I haven't heard necessarily of companies going out of business per se, but they are certainly racing to cut costs and become more efficient. And it's difficult with the volumes doing what they're doing and the revenue and the margins dropping. It's obviously a big deal. And so companies are having to make some very hard decisions, and managers are as well. And it would be rare. I mean, Rich, you and I are both going to New York, and I think it'll be nearly impossible to find some lender out there saying things are decent and we're actually hiring. Companies are hiring selectively, but it's tough to keep if you're doing not to drone on here, but if you're doing, let's say your underwriters can underwrite 2 files a day and you're locking in 50 files a day. Well, you need 25 underwriters to cover that business. Well, if your volume falls to only 25 files a day or 24 files a day, you only need 12 underwriters. So there have to be cuts. And like I said, companies are really racing to become more efficient and make those cuts and facing some very difficult choices, unfortunately.
Julian, basispoint.com, which is, if you've never read it before, any of our listeners, viewers, excellent, more than a blog. It's a media outlet that's cited constantly by a lot of different publications, housing, technology, money, right in the bailiwick of everything we talk about in this show and what's going on. And Julian's been in the industry a long time, UBS, Wells, Loan Depot, Rob's buddies at Lend US, long stint there, and now doing a little work with Total Expert, good friend of TMC for a long time, and the type of software, a purpose-built marketing operating system that lenders are using to do all the things that are going to be really, really important these next few years, retaining customers and nurturing leads and making their salespeople more productive. And just curious to get your broad perspective to get things rolling here on what the hell's going on right now in the mortgage industry.
Thanks. Let me pick up where Rob just left off, because I think we all, even the most disciplined of us, say, like the three of us that stare at a lot of headlines and or even create a lot of those headlines, can become subject to reading the headlines so often that you're like, oh, things are it is jarring, and these companies, the wheels are coming off. And I just don't think it's true. So I'll make a quick comment on that, and then we can bring it down to the production level. But we know that mortgage jobs surged 50% to accommodate record volume in the last couple of years. And now most of that is going away. And for those of us who have been to these wars before, scaling up and down makes for sexy headlines, and it feels jarring to the folks that are writing those headlines for the first time. But for all the true operators on the ground, including the TMC community, they know what's up. This is normal. So you make adjustments and you do your thing. I'm not saying it's fun, but it's normal for people who have done this before and been to these wars before. It feels a little bit more acute this time, having risen 2% from December to now. But with that said, it's no different than any other sharp turn. It's just the first sharp turn we've had in a little while, right? With that said, it's like this. You have, if I can plug in, say, the marketing bit, you have let's say marketing should, and because of orgs like TE, can be a profit center. But when you're getting into these stark moments from a financial planning and an operational efficiency standpoint, you're making these adjustments, let's be real. Sometimes marketing resources can get cut. Okay, what does that mean? It means that if I have fewer marketing resources, I got to get the deals, as Rob was saying before I think we went live. I got to get the deals into the hands of the LOs, not just having the, say, marketing teams kind of help deliver that stuff, right? So having data come through, say, let's just use TE as an example. I need to know exactly what my customers are doing in real time. And I, as the loan officer, need to get that on my phone, and I need to be able to take action on it right then and there. And then if that customer, say it's purchased, it's not going to close that day, I'm not going to lock it that day. I just need to get it pre-approved that day maybe, and do a TBD approval, and then stay with that person and not let them get sucked away by a realtor who is referring them away when they're out shopping for homes. That's the stuff I think that TE is good at right now, is letting those LOs get the deals in their hands right away with all the alerts and stuff that they've started to roll out this quarter, but then keep the thread on these long lead purchases. You got to make multiple bids and multiple bidding wars. Chrisman and I came up in a market environment in the Bay Area where bidding wars have been part of that market, forever. But that phenomenon went national over the last 18 months. And the way it works is that you got to do TBD approvals. You got to let your LOs engage in real time all the time on those pre-approvals and keep those people fresh. It's a Friday. You have to hit those people every Friday before they go shopping. How are you doing that? Are you remembering to hit everyone in your pre-approved pipeline all the time? Not so much, unless the technology is helping you. So that's kind of the playbook that I think that goes on for sales forces when marketing support gets cut in an acute budget moment. I can talk to some of the M&A stuff too, but I want to stick with this because I think this goes to what the TMC community cares about, which is how do I get and close more purchases in this type of environment?
People still buying homes. A lot of stories that have been out there. Oh, demand for housing market's cool. Purchase apps have been up, I think 3 weeks in a row. Purchase apps were up 5% this past week. Over the week before, it was 5% up the week before that. That's as rates continue to go up. So every home that's out there in the market is getting gobbled up immediately. And there is very strong underlying demand to buy homes, and every lender's got troves of pre-approved people just looking for one. Now that the affordability dynamics have lessened the pool of people that are willing or able to buy. But to your point, Julian, you got to be ready to pounce when you got somebody gets an opportunity to buy a home on the sales side of our business right now.
I would offer this, just everyone knows these stats, but let's make it really stark. The first quarter of last year was 70-30 refi purchase. This quarter right now, 2Q22, is the exact flip, right? It's 70-30 purchase refi. So everyone knows what that feels like on the ground, but those are the actual stats. And Rich, to your point, we're going to do 4.5 million purchase units this year, and we're going to do 4.5 million purchase units next year. So my advice to like everyone on the ground is, F all the headlines, because the headlines are not informed by what all the TMC lenders know, which is we got to stay in front of these folks. And if we do, that's how many units are available to all of us. And it's only about engaging those and getting them closed. It's just that simple.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman, and this week from Total Expert and TheBasisPoint.com, Julian Hebron. As always, comments, questions, thoughts, jokes, chat, or Q&A, we'll incorporate them into the show and have had a few funnel in already. Rob and Julian, this is something we're hearing about a lot, is these companies that are in the business of turning pre-approved wannabe home buyers into cash buyers. Julian, I'll start with you. Your thoughts on these programs, and then Rob, I'd be interested to hear what you've heard through your network on these companies. Niches
With loud voices, if I could put it in a phrase. The voices are loud enough to make you think that that's how the industry is going to be. But these companies haven't been tested in a cycle like this. And we're going to find out real quick how those capital intensive models don't age quite as well in a market like this. So to me, it is more like the playbooks that the TMC community is already familiar with for those that have been through a couple of these cycles, which is DTIs that are able to use the outgoing property. You got to qualify with the outgoing property, knowing what the end game DTI is going to be and qualifying new purchases based on that. That's the real ground game in a market context. I'll say it harshly. We all live in the real world, and that's the real world model. That is the market. This other stuff is niche stuff, in my view. Rob, you been hearing anything on these companies? Seems like there's 3, 4, 5 of them that, Julian's point, making a lot of noise right now. It's something for lenders to talk about.
There are 8 that I've counted, Rich, that are doing these kind of things. And I tend to agree with Julian in terms of a niche, niche players. However, what I'm seeing out there among a lot of lenders are that they are willing to do things that they haven't done over the last couple of years. So last couple of years, it's easy. FHA, VA, Fannie, Freddie, away you go. Now lenders are looking at bond programs. They're looking at housing finance authority programs. They're looking at, this cash deal, which doesn't flow through a warehouse bank. So it's a little bit different. They are looking at other programs. Obviously their adjustable rate mortgage guidelines have been dusted off, and so they are doing that. So lenders are in construction, to perm or construction loans, bridge loans, all kinds of things that these lenders are doing to facilitate their business. Basically, they've got these factories set up with underwriters and doc drawers and processors, and they got the e-sign mechanisms in place, I hope. And so they've got these factories that can produce something. And with a bank or a credit union, we've seen employees shift over to other parts of that bank or credit union, whether it's car loans or credit cards or whatever it is at that financial institution. Independent mortgage banks really don't have that luxury. And so they are looking at HELOCs, and they are looking at some of these other programs like the ones you just mentioned, Rich, to be able to utilize these people who understand the mechanics and can tweak themselves a little bit and adapt. I don't, maybe it's a flash in the pan, maybe they're here to stay. I know that, you would hear occasionally about programs that, that pop up and then they kind of go away. Equity sharing, for example, will let's all buy a house together, then share in the equity, sharing that. And so that was big for a while, and then that kind of died down. So I think lenders are just looking at different things, and obviously there are borrowers out there who want to borrow and lenders who want to lend. The question is at what price, at what program, at what rate. And this is something new. It may not last, but it's something a little bit new. I'm sure it'll be a conversation topic in New York.
ARMs on the rise again. Every week we're getting new refreshed data. Adjustable rate mortgages, the latest data from MBA in their most recent application report, 19% of that's loan amount volume in the most recent week. And that's the highest that's been in a long time. And just, I've been to a lot of conferences these last few weeks talking to bank. The dynamic we have now with ARMs is the secondary market's still soft form for reasons we've discussed in previous weeks, Rob. And it's not even 100 basis point spread between a 5-year ARM and a 30-year fixed rate right now in cost savings. And in a lot of cases, that's still the right loan for a borrower. But in talking to banks, what they're saying is they could go get as much of this business as they want right now. Just doing it a quarter below what the secondary market is offering, which is still a good deal for them as it relates to an earning asset on their balance sheet. But we've almost got like the flip-flop of last year from the depositories. The depositories were dying to put earning assets on the books the last couple of years, and there was nothing to be had because every residential loan was saleable, and they didn't want to put 30-year fixed rate stuff into twos on their balance sheet for all the obvious reasons. Now there's just as much business to be had. A lot of loan originators that are starving for volume, and they're battling that kind of challenge. And independent mortgage banks frustrated because there's not a good secondary market for ARMs. And with that, I'll go back to both you guys again, Julian, and then Rob, for your thoughts on this emerging topic.
I'm going to take it, I'll take it from, if you will, the production standpoint, and Rob surely will too, but he's the capital markets person, so I'm not. He'll take that one, but 100 bips is pretty high. I'm seeing more like 50-ish. Okay, but even if it's 50, right? If you're saying, and by the way, 50 is also like, say, more like a 7-year. So on the ground, what are you telling buyers right now? There's two factors. One is, I came out of this 3% world. That's when I started shopping for homes. Now I'm 2% higher. It's a material hit to my affordability. I think it's short-sighted to say, hey, just take an ARM and problem solved. But what you can do, and what I think is realistic, is if you look at the projections for what inflation, and therefore assume what's going to happen to rates, say by the end of 2023, we come to a more normal 3% core PCE-ish range. If you go across Goldman, Wells, JP, some of the big consensus estimates, if you're cutting core PC in half from what it is today, you could assume rates come back down. Let's call that 18 to 24 months, okay? So you can, in theory, look your client in the eye and say, here, take this 5 or 7, let's call it 3/8 to 3/4 in rate spread interest cost savings that you're going to save over that period would pay for a refi when the time comes. And that's a pretty good bet. But you do have to be able to look your buyers in the eye. This is if they're intending to stay in that, this isn't about like, well, you're going to move in 5 to 7 years anyway, because that math never pencils. Selling a home for 6% 5 years later, you might as well not do it, because that's a lot of cost. But assuming they're going to stay in the home, you do have to say, if you're willing to take some risk, here's where rate markets are likely to end up in 18 to 24 months. And we can get you into the lower rate now, then, but you take the ARM now. That's how I've been seeing it. That's what a lot of smart LOs are doing. And, as a long time originator, I've been through this before. And there's plenty of people that are like, I don't have a stomach taking the 30 at the higher rate. And maybe I refi anyway when the time comes, but I ain't taking the ARM now because we're staying there. So that's my take on the ground game.
So great comments. Obviously I have nothing to add on to those. The one of the questions that popped up, Rich, from Tom, was asking about, the speed that borrowers want things done, and go, just the transaction costs, and then the pricing that's out there. And I think that ties into this ARM discussion, because anytime the market, quote, the market, anytime any market goes up or down significantly and drastically, it causes, it kind of roils, the flock gets spooked, and different strange things happen, whether that's product or whether that's pricing, or whether it's just borrower behavior or originator behavior. And so the prices that are out there, the market has not adjusted to those prices yet. And to Tom's question, talking about, discount points and so forth, these, and I think we've talked about this before to some extent, you have investors out there and originators and everybody. It was let's just say a 3% world at par, or let's say 3% at 103, and now 3% are 30-year fixed or at 93. So you have this 10-point swing in mortgage-backed security pricing, and whether it's a fixed rate security or an ARM security or ARM prices in general, the investors and our lenders don't know how to price that yet. And we need some stability. We've actually got some stability. It's every day and every week that goes by, and we've kind of leveled off here in terms of rates. It helps with pricing, whether it's fixed rate or ARMs. And Julian's right. The borrowers, how are originators talking to borrowers about these programs, and especially adjustable rate programs? Well, it's an option. I mean, I remember for a while, it seemed like after Dodd-Frank and the CFPB started to crack knuckles, people were afraid of the ARMs. It's like, are ARMs against the law now? Are adjustable rate mortgages, prepayment penalty, are they against the law? Am I going to be examined by the CFPB if we do an indexed ARM program? And of course, that's not the case. ARMs serve a very useful purpose. It's just a matter of how and when and who. And so I think the pricing will come back, or as things are stable, the ARM pricing will come in. The 30-year fixed rate pricing, premium pricing, namely, will start to pop up, because you have a lot of investors out there who have lost 10 points on their securities, and they don't know where to price this stuff, and they don't want to pay a 5-point premium or a 3-point premium to something that, let's say, it pays off in 6 months or a year, because rates head back down because the economy starts to get a little bit sluggish. And so, there's a lot of, it's kind of like walking across a room in the dark. You're not going to go real fast. You're just going to kind of take your time and feel your way along until, it starts to get, until you can see. So investors are dealing with that now. And I think whether it's fixed or ARMs, that's the deal. And as long as we kind of stay in this range, I think the pricing will come back and the programs will come back, and ARMs may or may not continue on with their volume increase. Depends kind of on the yield curve slope and whether an ARM makes sense. And that's a great way for originators to be able to sell their services, not the internet lenders so much, but it is the ability for an experienced loan officer to sit there across the table from a borrower and say, here's why I think this makes sense or why it doesn't make sense. And they get to know those borrowers. It's not an internet kind of discussion. It's a one-on-one, LO to borrower situation where, once again, an LO can add value in talking about this topic, to Julian's point.
Two constants for all mortgage lenders right now. Rob, you mentioned it at the open, cutting costs. It's obviously top of mind with everybody. And then recruiting. Everybody is looking to cut costs and looking to recruit. Julian, you wrote a great piece that has withstood the test of time. Something along the lines of, the $1 million signing bonus is not a growth strategy. And just really seeing, obviously, some wild and wacky stuff out there right now with all the converging dynamics, and news this week of some lawsuits, some big lenders hiring teams of people from other big lenders, and your thoughts right now on just the recruiting climate, having been through a few of these.
I'll offer a couple notes, but I'll start with some stats on this one because, our friends at Ingenious have good data here. So let me give you a couple fun notes. In 2012, I'll do 20 and 21, just real quick, bank and non-bank stuff, just to sort of give everyone some perspective here. So the largest depository mortgage lender in this country in 2020 gained 2.5 billion in production from 2 top depositories. Likewise, they lost 5.5 billion to 2 top non-banks. And then the stats are similar in 21. Again, the largest depository mortgage lender in the country gained 1.34 billion from 2 top depositories, 2 of their competitors, and lost 2 billion in production to 2 top non-banks. Those are just really high level stats, but it really, and that was before Rob resurfaced this piece I wrote 4 years ago, very recently this month. That was before the recruiting dominoes started falling. So we could imagine that billions in production is moving all over the place, and everyone knows it who's dealing with this on the ground, right? So my joke was, $1 million signing bonus isn't a growth strategy. Going back to the headlines, makes a good headline, but the fine print is that just like if we think about M&A, there's always some multiple of Rev, EBITDA, or your balance sheet in the case of mortgage lenders. The same goes for LOs. So you can justify, if you're recruiting, you actually can justify paying a certain amount for, say, a super producing team, because they're like a company within a company, right? So I poked fun at that, but the fine print of that piece is like, if you're going to pay up, you better understand what that multiple is and how fast they're going to return. And we all know about clawbacks and this and that, but we also know that in these moments, I've been having conversations for 2 weeks of people that are moving back and forth between bank and non-bank. An example, people come from the banks, they go to a non-bank and they're like, my big bank sucks now. They go to a non-bank, and they're like, oh my God, I don't have non-agency product anymore, right? So my advice to the entire TMC community on recruiting is, and everyone knows this, your community is one of the smartest out there. So I'm preaching to the choir here, but you got to know your math on the recruiting if you are paying up, and you really got to vet folks. It's not about just trying to get them. I have another joke in previous wars that are now coming up again, which is regional managers tend to travel in packs with their core group of producers. And is it them seeking signing bonuses and then they're just plugging in their people? I always like to go for the individual producers from a recruiting standpoint. Forget the regional managers. No knock on regional managers. I'm just saying, focus on the production itself. If that's where you're paying and you have good clawbacks and you can keep them happy, just remember, it's going to take up to a year to keep them happy. You got to pay attention and you got to be ready for that, because loan officers are in that state where they're willing to go back to where they came from if you don't get it right.
Rob, any observations on the current recruiting climate?
Yeah, it is a math equation. It is a math, I should say math and legal situation where you have a team or an originator and they are doing so much, and sure, what I'm hearing is that potential suitors are going back to what was your volume in 2018 and 19. Everybody was going gangbusters in 2020, 2021. What percent of your origination was purchase? Tell me about your business, and then what kind of product are they originating? What's the profit margin on that? What has it been? At our company now, what's our profit margin on what that producer's making? So it becomes an actuarial conversation. And how long are they going to stick around? How long are you going to have them stick around with a signing bonus? Is there going to be a clawback? So it is a math thing. It's not a, it's not touchy feely. But that all said, when Julian reminded me of, we used to see, when LO comp was shifting 5, 10, 12 years ago or whatever, you would have these originators say, well, the grass is greener over there. I'm going to go to this bank, or I'm going to go to this independent mortgage bank. I'm going to go to this credit union. So there was this shuffling based on where they could think they were going to make the most money with the product set and the pricing and the lead source and so forth. We're seeing that again to some extent. But on the other hand, I continue to talk to very successful originators who say, I like my company. I get recruiting calls. Sure, I'll listen to a few of them, but you know what? I know the underwriters, I know the policies, I know the procedures, I know the products. And you know what, Rob, we don't have the best price, we don't have the best program, but you know what? For my borrowers and my skill set and my knowledge base, I like where I am, and I'm going to stay put. So I'm hearing that a fair amount, and so the companies who are, offering these signing bonuses, you have to remember, and there's some very smart companies who are offering these bonuses and very smart individuals who are taking them. But if I were talking to my son or daughter, whoever, I'd say, who are you getting? Are you getting a mercenary who is going to jump ship at 2 years and 1 day? Or are you getting somebody who has a cultural fit with your company? Because a lot of these lenders are like well-oiled machines, and they have a culture and they've got policies and procedures and so forth. And everybody's kind of fit into that, and they're used to it, and there's some loyalty there. And to bring somebody in who is going to, once again, spook the herd or ask for a lot of concessions or not know the guidelines or come in and complain the whole time, and it can be a real mess sometimes. So you just have to be careful. I think it is a math problem and a legal issue to make sure you're doing the right things, but you got to make sure you're getting the right person, and that can be an issue.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman, and this week the founder and editor of thebasispoint.com, and doing some work with our good friends at Total Expert, longtime TMC marketing operating system that many of our members are using.
I have a question, Rich. I'm going to interrupt talking about Total Expert. So Julian, you've been around the business a fair amount. What attracted you to Total Expert? Why are you here today representing Total Expert?
Well, I'll go way back. This is fun because I'll obviously see you guys at Secondary, but forget Secondary. One of the shows that you guys are like, Rob, like Secondary is your stomping ground. MBA Tech was like, is mine, right? So I was with my CIO when I was at Lend US, and we were trying to build tech stack stuff a number of years ago. And we saw a demo from TE back then, and we were really struggling. We had a proprietary marketing system, but the world had started to move a lot faster. And we saw this and we're like, oh my gosh. And here's what's interesting is that was in the last big acute purchase market shift. And one of the things that drew us to it then as a buyer of the product was that we were just like, all right, the purchase market playbook stuff is like nails, because you can arm your realtors with what they need to help run their funnel. And you as the loan officer can do that with your realtor hand in hand. So going back to a previous comment I made today, it's not just about getting that pre-approval done. You got to bring it over the line, and you got to deliver that commission to that realtor, or that realtor's not going to keep delivering you more deals. And so there's a number of things embedded in how they enable the running of the purchase playbook for LOs that I've always liked. Here's what's funny about now. I'm close with the founder, Joe Elu, and the team, and I remind them of that, but they're onto other stuff. They are onto real-time alerts on everything. They're on two-way SMS. They're all the things that go to, Rob, to your point, Dodd-Frank for us old schoolers is not that old. and the idea of needing to be hyper compliant as you're working super long-term leads and have everything on a paper trail, but also have the LO be able to do their thing their way and communicate with their borrowers via text and everything, and have that be all within the machine, so to speak, both from a compliance, but also a I'm trying to get this deal closed standpoint. They power all this stuff in a way that I think is got some special sauce relative to some of the other platforms. And I think it goes to the fact that they get it. They do get what the thing about TMC and its community is, that it's full of all the lenders that are like in the freaking weeds, you know, and TE gets lenders like that. That's why I have always hung in close with them, because they do get it. And you guys know me, I'm technical, and there's a lot of fintech bells and whistles out there, but this team knows what's up with that.
Good, good to know. You're a good cheerleader.
And
But I don't take that stuff lightly. Like I said, I mean, I do. It's like some fintechs don't know the weeds. That's my point. And I think it's a critical point, because some stuff, Rob and we've talked about this for years. Some stuff is bells and whistles, and some stuff is like, oh, they get what I'm doing on the ground with, say, a TBD approval, and what happens with that as it plays out and multiple offers are being made and we finally get ratified and we need to bring that loan home, right?
Well, that's good to know. Thank you. It's nice to have a somebody like yourself who has the production background and the different companies that you've worked with to be able to talk like that about Total Expert. So well done.
absolutely. And Total Expert, not a public company, but the public mortgage companies, first quarter earnings, I guess what you would have expected. The companies that did show profit, it was largely due to a mortgage servicing right book adjustments. And, you know, I think it reminded everybody that that's largely why mortgage lenders accumulate or acquire servicing assets. Kind of acts as a natural hedge to production. And, you know, Rob, any thoughts on any of the Q1 earnings stuff?
Let me tell you about water stocks, Rich. Let me tell you about my retirement.
Your water stock, you know, I was making fun of you a year ago when I was riding the GameStop bandwagon, but all of a sudden it seems sage as I look at my stock portfolio currently.
I don't even know it. So Julian, just to fill you in, we talk about stocks and woe to anybody who doesn't diversify their money. And a lot of people have it in cash. You have it in cash, you're losing 7 or 8% a year just based on inflation. You buy stocks and suddenly the NASDAQ is plummeting, the S&P is down, so forth. And I'm just a stodgy buy and hold kind of person. And I think, you know, when push comes to shove, when the apocalypse hits, I don't need the latest Apple phone. I need fresh water. And so I've always put my money into boring water utility stocks. So, and I don't even know, Rich, what they're doing. I'm sure they're probably down, but people still need water and people still need clean water and they need it piped to them and so forth. Yeah, the mortgage company stocks that are out there, they are like the canary in the coal mine. They are the barometer, the bellwether, whatever you want to say, for the rest of the industry. So it's not, you can't really point at Loan Depot or United Wholesale or Home Point or Who Guild and say, nah, you know, you're losing money. Look at your stock prices at the bottom, because that applies to the entire industry. And there's a reason why those stocks are down. And those reasons, or I should say, there are reasons why those stocks are down. And those same reasons apply to every lender in the United States. And that is margin, volume, revenue for everybody is down. And to be able to see that demonstrated in the price of a stock, I think is very important for us as an industry. So if you are Julian and Rich's Mortgage, and you guys are the owners and you're thinking about selling and you're watching the stock prices of these companies go down because the first quarter stinks and things aren't improving much, well, that valuation is also impacting your company's value. If you're trying to find a buyer for your company, they're going to say, well, it's not worth as much as it was 6 months ago or a year ago. So it's nice to have that representation in black and white and see the numbers, but it applies to the whole industry. And that's, to Julian's point, we've been through these business cycles before. We'll go through them again. And, here we are. So, buck it up, Buttercup. You can quote me on that, Rich, like buck it up, Buttercup.
I would add to, if I may, Rich, can I add to that one?
Absolutely.
I think that mortgage has always been a cash flow, not a valuation business. Okay. So Rob's absolutely right. Like, what's true of the public orgs is true of everybody else. And the rest is about execution on the ground. And we know, and again, I know I keep harping on this, but your community knows how to do this. And so it's not about some sexy stock price. It's about doing right for your customers and taking these 4.5 million purchase units that are going to happen this year and getting as many as possible. And that's it, right? It's fun to have that data so that we can all become more educated on how mortgage financials work, because this is the first time in a couple cycles that we've had a number of public companies where everyone gets to see the numbers, not just the managers of private companies. But with that said, it's a cash flow business, and there's tons of great operators, including tons in the TMC network, that know what to do. And that's the only thing that matters. So it's fun to talk about, but operations and winning these 4.5 million purchase units this year is the only game in town, as far as I'm concerned.
MBA Secondary looms, one of the bigger mortgage conferences of the year. How many years in a row has it been at the Marriott Marquis in Times Square? Has it been 20? This is the one conference, because I was a secondary guy, that I've been going to for 25 years. I feel like it was at one point at the Hilton in New York. I want on Manhattan, but that's the only other venue I remember.
I made fun of the elevator system earlier this week, Rich. I mean, it's just, I know what I don't know. The elevators are what, huh?
Door I, right? Yeah.
The door, like, IK, where do I go? Who, the lottery, who else is going to be on my elevator with me? And it's like, you walk through the lobby, it's like, hey, and you're, I don't know, it's almost comforting in its idiosyncrasies. So.
Julian, anything in particular you're heading to New York this week, wanting to ear to the ground about, or any agenda or MO for your trip to New York?
Sort of within MBA Secondary, but I'm also doing the Goldman conference. And to my previous point, this is the investor perspective always, and the fintech perspective. And I love the dichotomy of, here's the MBA folks that really, really know how the comments that I just made manifest, which is, this is a gain on sale management phase. That's what we do as an industry, is we manage gain on sale. That's what we do. And this is a group that knows this stuff cold, and you come out of that, and then you go to the more lofty, visionary, investor-oriented, fintech-oriented conference, where they're talking about some of the specialty models that you brought up before and more of that. So to me, I'm always, the basis point is nothing if not trying to connect dots on all of these things together. So that's really my objective for next week, is, as always, to connect all the dots.
Rich, we've run out of time again.
We've run out of time, always flies by. And in the chat, our own Amy Bohr has linked the link to the registration portal for our party Tuesday. Margaritas in Manhattan. One thing TMC does well is throw large parties, and we'll be at it once again. Our partners, Maxwell, Stewart, Zactus, which is the old Credit Plus. So some great partners at TMC going in on what is always one of the bigger bashes at the big conferences. So it's Tuesday from 4:30 to 6:30, and hope to see the two of you there, and all of our listeners and viewers, and as always, appreciate your attendance. Wrapping up the week with us every Friday at 3 p.m. Eastern with the rundown with Rob and Rich. And Rob, looking forward to seeing you this weekend. And
too.
good seeing you as always. And Julian, always good to chat, man. Always enjoy getting your perspective on our industry, finance in general, technology. And it was great to have you on the show today.
Thanks for having
Absolutely.
me. It's awesome as always.
Absolutely. Until next Friday, everyone, have a great weekend all, and hope to see many of you in the Big Apple in the next few days. Take care, guys.
See you guys.